Hi, everyone. I'm Andrew Simon, the CEO at MacroHive, and welcome to another edition of The Week Ahead with my esteemed colleague, Dominique. Welcome. How's everything? And as we always like to say, it's been a quite interesting week this week for, I guess, keeping up the consistency that every week this year has been extremely interesting, but this one particularly. So let's start off as we like to do is kind of recap your thoughts on any data, kind of speeches, market reactions over the past week.
Where do I start? So first of all, the data wasn't great for the Fed. It showed the inflation data, especially PC, was core month for month, higher than expected, same as the CPI, which just shows the extent of inflationary pressures because PC is typically lower than the CPI.
Right.
So
And that's one of the things the Fed likes to look at, right? PC.
Oh, definitely. And then, the spending data was also strong. You look at household savings rates, they are down to, I think, where they were in the 70s, 3%, something, which is exactly the opposite of what you want. You look at
What does that mean? Does that mean that people are comfortable with that they're going to keep earning money, or does that mean like they can't afford to keep up whatever lifestyle that they're currently at?
So probably, yeah, they expect to make more money because the labor market is so tight. And you read every day in the newspaper stories about employers, big employers like Amazon, especially raising wages. And also they still have the impact of the huge government handouts, which they've been spending. Of course, at one point it will stop, but meanwhile, employment is growing so strongly. We're talking about on an annual rate, 4%. So it's a 4% real increase in household income. They can afford to borrow a little more, which is exactly what's happening. Credit to household, if you exclude student loan, is booming. I mean, especially non-mortgage credit. So there is this expectation that
What is that? That's like credit card debt or car
credit
loan?
card debt, car loans. I mean, car loans are keeping up with car prices, basically the overall amount of the loans and the maturity are going up.
Right.
So poor Fed, no signs that their tightening is slowing the economy yet. Oh, and I forgot to mention the decline in jobless claims, initial claims, the lowest in 10 months, and we are obviously on a downward path. We've been on a downward path.
Close to the lowest we've seen in like 50, 60 years, right? Outside of, I guess, a year ago or so.
It totally.
Yeah, I mean that has to be a shock to like 99% of people. I know who track U.S. economy, U.S. economics. I mean, I know over the summer when again we were talking about this recession, this thing, and you said I still think there's a chance that the U.S. economy can accelerate, which is kind of what we're seeing. Certainly, the labor market. Are you surprised by how?
Yes, I mean, I'm waiting for the next NFP on Friday, which could be a shocker. The consensus, in my view, is too timid, 250,000. But let's not jump to the week ahead and talk a little more about what happened last week. The Fed speak is basically reflecting the acceleration of the US economy. And remember that what they were calling for in their last meeting was actually, excuse me, a slowdown below potential. And obviously it's not happening. So they were uniformly quite bearish. hawkish, bearish for us. And
Exactly.
yeah, unfortunately. And what was extraordinary was their reaction to the volatility that we've seen in the UK. So in the US, they are ignoring the market volatility because they want tighter financial conditions. And in terms of the UK, they were completely oblivious. And to be honest, you didn't see much contagion so far. I mean, you
Right.
have little signs of nervousness, like, for instance, the reverse repo at the Fed was up a little bit.
You and I were talking about, right?
Yeah, but not, not super up. So there is no sign of a panic in US markets yet, or of deleveraging, which is a sort of thing that could get the Fed to pause.
Yeah.
Um,
What about Brainard's like a few people I saw, I think it was on Friday, saying she at least commented or mentioned emerging markets, and I don't know if she other things, but things outside of the US and potentially the strength of the dollar, or especially countries that are pegged to the dollar having to deal with such an acceleration in interest rates.
So Brainard gave us the latest version, very learned and very polite, of, the old US doctrine on the dollar, which is our currency, your problem. So she very politely expressed sympathy for countries, who had to deal with the consequences, while also mentioning that if they had kept their house in order, perhaps the consequences would not be so dire. All this in a very academic and very, very polite and mild manner. But basically, to be fair to Brainard and to the Fed, the Congress gives them a mandate for the US economy, not for the world economy. And so that always creates tension with the global role of the dollar. So, but what I thought was interesting in this speech, and really what our listeners and investors need to focus on, is the issue of the long and variable lags of monetary policy. This is an expression that was coined by none other than Milton Friedman in the 60s or 70s, a long, long time ago. And it's the idea that it takes time for monetary policy to impact the economy. And so what we have at the moment within the FOMC is a debate between the hawk, who said we're so far behind the curve, we really need to keep catching up, and the doves like Evans, who say, hold on, we've done so much. And to be fair, the Fed has hiked at the fastest pace since the Fed funds rate became the operational target in 1982. And those people, the doves, are saying we need to slow and take stock of where things are. And it's not a simple issue. It really is about risk management, weighing the risk of doing too much and crashing the economy against the risk of falling further behind the curve if you slow. And what I think is going to settle the debate is going to be inflation data. We get a few more prints, or not even a few more prints. We have, I think, 1 or 2 more prints between now and the early November data, and it's another 75 basis point. And as you know, my view is that we go 75 a meeting until the Fed funds get to a positive, real positive place, and which I think is mid-year. And this is where I see when I see my 8% call getting realized.
So wait, so you think we'll get to 8% by mid next year? No.
Yeah, because we're going to go 75 based on my inflation view.
Right.
We go 75 bips each meeting. And so basically the doves are going to be overrun by the inflation data.
By the way, your call since, I guess, February, March has definitely been amazingly prescient and so valuable, I think, for our clients, especially professional clients, but even So you had a great piece on our Prime. For those people who are not, not working in a big hedge fund or bank or stuff, definitely check that out because there's great content there as well. But just the fact of how hawkish the Fed was going to be and how far they may have to go, like we're talking about now, and how negative that would be for risk. I mean, even I'm in the in-between camp because even I'm like, I mean, there's a point something is going to break. And okay, fine. And it may be outside the US, by the way. But it may be so significant, like maybe something specifically in the UK or Europe or something. But like we said, I don't know what would be so severe in the private credit market, asset manager insurance companies having significant unsecured loans that are going under, so like something. But again, that this hiking cycle has been so quick in such a short period of time. Even if things were breaking, it could take 6, 9, 12 months for it to come out anyway, I think.
And Andrew, if you look at so I'm 100% with you, something breaks. I think it breaks first outside of the US.
It feels like it. At this point, that's what it feels like. My concern, which I think this week changed, and then let's move to the week ahead, is, and by the way, it may have just been about what was happening in the UK, but this was the first time where we didn't just see strong data, the curve inverts, yada, yada, yada. Like now, like we see strong data, like there was a couple of days in the middle of the week where like the curve was steepening. And I remember thinking, even Sunday night, when the dollar was very strong this past, 5 days ago, I was telling Bilal that if I saw how much the dollar had moved, I just assumed bonds would have rallied a lot. And when I saw that the curve, especially the back end, sold off more, I'm like, that seemed like that was like, whoa, like things are really starting to come apart. And maybe obviously Bank of England kind of stabilized things, but I still feel like stuff has changed now. Like, I don't know if I'm in that super big inversion kind of, and that will be, but last point is, Bilal's point is, yeah, I hear you, but like, that's actually helping the Fed. So I don't think, he's not as convinced that this is such a big thing. He thinks in the end, it's helping them, restrict financial conditions more. So it's kind of helping them do their job. And maybe they'll have to do less because of that.
Well, and I tend to agree with Bilal. And I would add the fact that the curve steepen could actually show that markets believe the Fed will be able to tighten further without breaking things in the US. And don't get me wrong, things will break up in the US. The more I think about it, the more I'm convinced. But if you look historically at the previous financial crisis we've had, so the tech bubble and the GFC, things break after the Fed has reached the terminal rate. And in the case of the tech bubble, things broke almost right away. The sell-off starting almost once the Fed had gone to the terminal rate. In the case of the GFC, there was, I think the Fed reached the terminal rate in early 2006, and then things starting to fall apart a year later.
Yeah, there was a significant lag. Yeah.
So as we get on with this tightening cycle, we will find out more where the pockets of vulnerability are. So we already know crypto, zero cash flow companies,
emerging market corporates.
Emerging market, yeah. And the UK. I mean, and also just to give, how I like to be contrarian. I try not to do it on purpose, but I just enjoy it so much. I mean, you could argue that, the UK pension funds are going through a lot of travails, less so, it seems, in the US, perhaps because we have fewer defined benefits. Yes. So we don't have as much LDI. But you could argue that this correction in yields is actually very positive for pension funds because they will be able to earn the returns.
Yeah, pretty significant.
And it increases their liabilities. So you could say that, it's kind of the pain of becoming healthy again. So if you want to give it a positive spin, that could be it.
Yep. Okay. All right. Let's move to the week ahead, and obviously we have the big one, Friday payrolls. But yeah, anything else that people look at and then kind of whether speeches or any political stuff, data, and then obviously we can dive in quickly on the payrolls on Friday.
The payroll is a big one, and my view on the payroll is that the monthly data is so volatile that trying to predict it to the third decimal point is a futile exercise. So I tend to look at it more in the context of broad macro trends, and in the context of the broad macro trends, I think 250,000. Which is what the consensus is predicting, it's probably too timid. The other thing that I will be looking for, no increase, perhaps even a decrease in participation. And
oh, really? So that would be pretty disappointing, I guess. So the Fed views it. I mean, they can look at it both ways, but the Fed basically increase in participation, they'll feel more comfortable, even if it's strong, like numbers are strong and even wage growth. Wages are going higher, but they'll assume over time more people, more supply for jobs that should eventually slow things down or bring wages down. And if not, then if the participation rate is not going higher, then that's pretty bad.
Yeah, but I would say that given how anemic the recovery in participation has been, the Fed is going to look not just for one good data point, but they will be looking for a trend. So even if we did get, contrary to my expectation, we did get a good number on participations, I'd want to see a series of those before changing, the pace of hikes. So so participation, wages, I think my view is that wages are going up. We've seen very
This is the average hourly earnings.
Yeah, though it's not the most reliable data. The two pieces of wage data that the Fed is looking at are the employment cost index, but it's quarterly data. And the Atlanta Fed median wage data, and this will not get on the day of the NFP. But still, obviously, if we get an increase in the hourly wage, it's another nail on the coffin of the FOMC doves. So in terms of data, this is the first week of the month. So we get the ISM, and there, the consensus thinks we get a sideways move, and I tend to agree with them. Again, this is volatile data. We need to look at the trend. Also, the data gets revised so much. The consumer credit is something else that I'm looking at because it's really booming, and it's showing us that households are not saving more, they're saving less. Trade balance is another one that I'm looking at because we've had a really very impressive turnaround, which I think is in part the impact of the reshoring. I wrote a note about this. We have, things are changing very deep.
Which is really surprising considering how strong the dollar is.
Yeah, but basically what's going on is that government policy is offsetting the impact of the dollar. Government policy plus growing geopolitical risk. And this geopolitical risk, look at what happened to the pipeline, the Nord Stream pipeline being sabotaged. It's going up, it's not going down. And by the way, this was one of the things that Brainard, who I really think of as as a dove disguised as a hawk. She was listing all the positive risk to inflation, and geopolitical risk figured very prominently. So the consensus is hoping for another improvement in the trade balance. It makes sense to me, and of course that's supportive of growth. And also one thing which we should really keep in mind, even though it's not a one-off discrete event, we are in a new fiscal year. And by the way, our president over the weekend is going to sign a continuing resolution until mid-December so that the government can keep going. But basically fiscal consolidation is behind us. But we had an enormous fiscal consolidation last year, which in my view explained the slowdown in growth. It's over. And in fact, the last deficit number we got, which I believe was for August, showed an increase year on year in the deficit for the first time in a year or so. So, this is not going to be an easy ride for investors.
This is the issue that governments around the world are, or economies around the world are having to deal with, which are central banks are raising rates, but governments are continuing to spend.
Spot on.
Like, and not like the energy stuff in Europe and
exactly. And actually Henry has a really interesting note on that, and Bilal as well. They had an amazing call on euro pound. So I hope our readers will read it.
Yes. I'll go into that second, but last thing. So I saw that there's going to be a ruling on the student debt, and I think you or Bilal, very interestingly put out is, especially Biden and other leaders were saying UK is just giving out handouts to the rich, but obviously it's also kind of to the rich or middle class to the rich for doing away with student debt. What are the chances that it comes out that it's illegal, what the government is trying to do?
40%, because it has. So basically what's happened is that you had 4 Republican states that sued the administration, and the administration obviously wants to start forgiving before the elections, before November 8th. And so the question is whether the courts will rule fast enough and in favor of the plaintiffs to stop this thing from going ahead. But you're absolutely right, Andrew. This is another handout, another regressive handout. And what's interesting is the lack of reaction of markets, which could reflect the scale of the handout and the fact that since the US is still the world currency, it can afford a lot more bad policies than other countries can, which again...
Especially in this environment.
Exactly.
More because everyone else is in a worse position.
Exactly.
Anything else for this investors and clients should be thinking about?
I think that's the gist of it. I mean, in terms of our elections, nothing changed there. Democrats could keep the Senate. Republicans are likely to win the House. Next year, this could mean more restrictive fiscal policy. But
especially if they get both.
Yeah, 5 weeks is a long time in politics, especially in US politics. So
yes.
It's
okay, awesome. Well, thank you so much for another great edition of the Week Ahead. And just to kind of reiterate for our pro clients, we put out some amazing research this past week, a lot of stuff on the UK. Bilal's insanely contrarian call of selling euro sterling, I think on Tuesday, which ended up being has been a fantastic call. I personally was in the camp. I think the dollar continues against both of them, but which I still think medium longer term. But the fact that we had such a big rally in the pound really caught a lot of people out, and that was a great call. And it shows when great example of kind of Bilal has this framework which he's built up over the last 20-25 years, and kind of really likes to utilize that and put that into context and coming up with ideas. even if I would say out of 20 people, 19 people were pushed back on the idea. So I don't know if it continues to play out, but I certainly am sympathetic that I think certainly over the winter, Europe may be in the same or worse situation. And later in the week, we saw the announcement by Germany for up to 200 billion to support not just low-income households, but households in general and businesses. In addition, for our kind of free prime, people who have never checked out MacroHive before, I was just looking through this thing that we do towards the end of the week where we, which is called Prime Trades and Ideas, and which kind of recaps overall our views on crypto, different currencies, commodities, a great breakdown on our thoughts on asset allocation. And there's a lot in there. Actually looking through things, there's a lot in one article, but the way it's presented is fantastic. And as always, we'd love for people to check that out. So just go to macrohive.com, please check it out. And everyone, especially you, Dominique, have a great weekend, because it feels like, and I'm going to go on a limb, it's going to be a pretty busy and volatile week coming up.
Definitely. So good luck, everybody.
Yes. Thank you. Bye.
Yeah, Andrew. Bye.